Welcome to your daily solo 401k webinar and Q&A session brought to you by my solo 401k Financial, where we help you stop overpaying taxes and start building real retirement wealth. We've got a good topic today. It's geared more towards institutional advisors. Here at my solo 401k Financial, we've been in business since 2009, and we have a lot of institutional advisors on our platform. So today's webinar is geared towards advisors regarding how a solo 401k plan can be opened here in 2026 so that you can help your clients process the Mega Backdoor Roth solo 401k strategy for tax year 2025. That is, anyone who opens a solo 401k plan here in 2026, it is not too late to then make voluntary after-tax solo 401k contributions for tax year 2025 as part of the Mega Backdoor Roth solo 401k strategy. So today, you're going to discover a little known strategy that allows your clients to open a solo 401k plan in 2026 and still make contributions. That is voluntary after-tax solo 401k contributions as part of the Mega Backdoor Roth strategy for tax year 2025, which is a way to maximize tax-free retirement savings for self-employed individuals. We're also going to talk about how you, as the advisor, can utilize your broker dealer. So we'll walk you through how you can use your broker dealer platform, whether it's Fidelity on the institutional side, Charles Schwab on the institutional side, Altruist on the institutional side, or any other broker dealer that you clear through or custody through. And this will deliver a seamless experience for you and your clients. So a question we quite often get is, can I use my broker dealer to custody the solo 401k assets? And the answer is yes. Here at my solo 401k Financial, we take the approach of letting you, as the advisor, in conjunction with your client, choose where to hold the solo 401k retirement funds at. That's one of the reasons we're so popular on the institutional side. Obviously, we also service the retail side for those who are not advisors and are listening to today's webinar. So we're going to unpack all of this today. So again, even if a solo 401k is adopted in 2026, in some cases, you're going to be able to not only make voluntary after-tax solo 401k contributions, but you can still also make employee salary deferral contributions. And that's true if your self-employed business is taxed as a sole proprietorship. Secure Act 2.0 changed the contribution deadline across the board for all self-employed businesses, but it's more advantageous for a sole proprietorship in that with the sole proprietorship, self-employed business, you actually have until April 15 of 2026 to open and make the employee solo 401k contributions. That's only available for a sole proprietorship self-employed business or an LLC taxed as a sole proprietorship, for example. However, with respect to employee voluntary after-tax solo 401k contributions, which are part of the 415 overall limit, those can actually be made across the board for all self-employed businesses, whether it's a sole proprietorship, partnership, S corporation, or an LLC taxed at any of the above. Those employee contributions allow you to open up a solo 401k on the for 2020 and in 2026 so that you can make voluntary after-tax solo 401k contributions by the business tax return due date here in 2026 plus timely filed extension. So we're going to talk about that as well. So we would, as always, if this information is helpful, we would appreciate if you like and subscribe to our YouTube channel and like us across all the various social platforms. It helps to get the word out to other advisors and even solopreneurs about the content we deliver every day. And of course, you're welcome to type over questions during the live stream. Go ahead and type those over so we can make sure we get to them all. They don't have to be specific to today's topic. They can be regarding any topic regarding IRAs or solo 401k plans. So why an advisor built solo 401k such as one provided by my solo 401k financial? Well, it's the solo 401k plan is designed for self-employed individuals, and you can make higher contributions with the solo 401k plan than you can with an IRA, for example, and in many instances, it takes less self-employment income to maximize annual contributions when you compare it to a SIP IRA. Also, with the solo 401k plan, it allows for the Mega Backdoor Roth solo 401k strategy, which is a way to indirectly contribute more Roth funds into your retirement account. And again, as an advisor, you get to custody the funds at the broker dealer of your choice in conjunction with your client. So the key strategy overview for today is that you can open a solo 401k plan here in 2026, and you're going to be able to make voluntary after-tax solo 401k contributions for tax year 2025 here in 2026 by the business tax return due date, including extension. So why does this work? Well, as I mentioned a little bit earlier, Secure Act 2.0 greatly changed the solo 401k contribution deadlines and also the setup deadline. So as long as you adopt that solo 401k plan by your business tax return due date, including extension, here in 2026, and also make the contribution, that is the voluntary after-tax solo 401k contribution, you're going to be able to contribute voluntary after-tax solo 401k contributions for tax year 2025 here in 2026. So for example, if your self-employed business is taxed as a sole proprietorship, then you're going to have until April 15 of 2026 to open that solo 401k plan and make the voluntary after-tax solo 401k contributions. Now, as I mentioned earlier, with the sole proprietorship, you can even make employee pre-tax or employee Roth solo 401k contributions by April 15. That's only available to sole proprietorships regarding the employee pre-tax and employee Roth solo 401k contributions. If you file an extension for that sole proprietorship, you're going to have until October 15 of 2026 to open and make voluntary after-tax solo 401k contributions for tax year 2025. You can even make employer profit sharing contributions as well by October 15 of 2026 for tax year 2025. On the other hand, if your self-employed business is taxed as an S corporation or partnership, then the voluntary after-tax solo 401k contribution for tax year 2025 can be made by March 15 of 2026 if you open that solo 401k plan by March 15 of 2026. And you would make the contribution by then as well. But if you file for an extension on that partnership, so a business tax return extension, you're going to have an extra 6 months. So you would have until September 15 of 2026 to both open the solo 401k plan and also make year 2025 solo 401k voluntary after-tax solo 401k contributions. And that's also for the S Corp. And actually, that's also for employer profit sharing contributions. Note, however, that you're not going to be able to make employee pre-tax or employee Roth solo 401k contributions in 2026 if your self-employed business is taxed as a partnership or S corporation if you're opening the plan for the first time here in 2026, but you will be able to make voluntary after-tax solo 401k contributions and or employer profit sharing solo 401k contributions for tax year 2025. We're going to go over that a little bit more. We're going to keep on covering that because it can get a little convoluted if you're not used to dealing with solo 401k plans. So let's see here. Mega Backdoor Roth explained. So with the Mega Backdoor Roth solo 401k, that consists of making voluntary after-tax solo 401k contributions. And then you can convert those voluntary after-tax solo 401k contributions to the Roth solo 401k or to the Roth IRA for that matter. So conversion options, again, you can do an in-plan conversion from the voluntary after-tax solo 401k to the Roth solo 401k holding account, known as the designated Roth account, or you can convert to the Roth IRA instead through a rollover. It's called a conversion rollover. Both of these events would result in having to issue a Form 1099-R, which we would handle here at my solo 401k financial at no additional fee. In short, that would be covered in our annual fee. So here's an example of the Mega Backdoor Roth solo 401k strategy in action. So this slide here illustrates a one participant plan. Let's say the individual is that the owner only individual has an S corporation self-employed business. So the business, that is the S corporation, sponsors the solo 401k plan. We would help that individual through his advisor open up the holding accounts, aka brokerage accounts on the institutional side. Of course, we can also do this for retail clients, but today we're honing in on institutional brokerage accounts. And again, you can utilize, the advisor can utilize Fidelity, Schwab, Altruis, or their broker dealer of choice, typically who they clear through. So we would help you to open up those brokerage accounts by drafting those brokerage forms, or you can do it on your own. But we do draft those for clients who request it. And then we would draft at least, if you're doing the Mega Backdoor Roth strategy, and you're going to convert to the Roth solo 401k, we would help you to open at least 2 brokerage accounts, the after tax and the Roth, under the solo 401k plan, because once you make that voluntary after tax solo 401k contribution, it immediately gets converted to the Roth solo 401k plan. Of course, we can help you to open up the pre-tax brokerage account, especially if you plan to make tax year 2026 contributions, or if you want to consolidate IRAs or former employer plans over to the solo 401k. Those transfers of IRAs or former employer plans don't impact the annual contributions that can be made to the solo 401k plan. And as I mentioned earlier, if your self-employed business is taxed as a sole proprietorship, you actually have until April 15 of 2026 to open that solo 401k plan and make employee pre-tax solo 401k contributions and even employee Roth solo 401k contributions. That's only available to sole proprietorships. But if the business is taxed as a sole proprietorship, you're going to be able to make those voluntary after-tax solo 401k contributions for tax year 2025 if you open that solo 401k plan here in 2026 by the business tax return due date plus timely filed extension. And then you can convert those directly to the Roth solo 401k plan. And then once that conversion is processed, once you move those funds from the voluntary after-tax solo 401k bucket to the Roth solo 401k bucket, you would complete our online Form 1099-R request form so we collect the necessary information to issue the Form 1099-R to report the Mega Backdoor Roth conversion to the IRS. This slide here, it's just like the prior slide, except this is an example of a two-participant plan where, for example, you have an S corporation, self-employed business, and you may have two owners, or maybe both spouses are working in the same S corporation business. Therefore, they can both participate in the same solo 401k plan because the plan is sponsored by the self-employed business, and then they would each have separate holding accounts to hold their contributions under the plan. Again, because a solo 401k plan is a defined contribution plan, not a defined benefit plan, you are required to have separate participant, aka holding accounts for each participant, in this example, each spouse. So they would each be able to process the Mega Backdoor Roth solo 401k conversion for tax year 2026 by making tax year 2025 voluntary after-tax solo 401k contributions, therefore doubling up on the amount of Mega Backdoor Roth solo 401k funds between both spouses for tax year 2026 by making those tax year 2025 contributions here in 2026 and processing the Mega Backdoor Roth solo 401k conversions here in 2026. So the Mega Backdoor Roth is very powerful because, again, it's a way to indirectly get more Roth solo 401k funds into your retirement account. For example, for tax year 2025, you can contribute all the way up to the overall limit of $70,000 as a voluntary after-tax solo 401k contribution and immediately convert that $70,000 to the Roth solo 401k. So each spouse would make that $70,000 voluntary after-tax solo 401k contribution to their separate voluntary after-tax solo 401k brokerage account, and then they would convert those funds to their respective Roth solo 401k brokerage accounts or to a Roth IRA. So that's why the Mega Backdoor Roth is so powerful and so popular. It's worth noting that catch-up contributions, whether the normal catch-up contribution or the super catch-up contribution, that can never be used towards the Mega Backdoor Roth solo 401k strategy. That is, it cannot be made as a voluntary after-tax solo 401k contribution, but you can make it as a Roth solo 401k contribution. So as I already touched on earlier, for whenever you process a Mega Backdoor Roth conversion, tax reporting applies. Specifically, a Form 1099-R is issued to report that voluntary after-tax solo 401k conversion to the Roth IRA or to the Roth solo 401k. You want to immediately convert those voluntary after-tax contributions so that there are little gains. Because when the gains are converted to the Roth solo 401k or the Roth IRA, just the gains will be taxable, but the bases will not. So you want to convert as little as possible gains. So that's why you want to convert. You want to process that Mega Backdoor Roth solo 401k conversion immediately. It's also worth noting that even if you make a voluntary after-tax solo 401k contribution here in 2026 for tax year 2025, that's not going to impact your ability to also make a tax year 2026 voluntary after-tax solo 401k contribution here in 2026 and also process a conversion of those funds as well, which would result in converting both the tax year 2025 voluntary after-tax contribution funds as well as the tax year 2026 voluntary after-tax contribution funds. So in short, your tax year 2025 voluntary after-tax contributions that you make in tax year 2026 will not impact your tax year 2026 voluntary after-tax solo 401k contributions either. And of course, when you make voluntary after-tax solo 401k contributions, you don't get a deduction on your taxes for those contributions. Therefore, they don't get reported anywhere on your personal or business tax return. Instead, they get reported on that Form 1099-R. But the trade-off is that all the gains, once those voluntary after-tax solo 401k funds get converted to the Roth solo 401k Roth IRA, the trade-off is that all of those gains are going to grow tax-free for years to come. So the deadline rule again is that the plan must be adopted by the business tax return due date, including extension here in 2026, if you want to be able to make tax year 2025 voluntary after-tax solo 401k contributions. And you'll be able to do that by your business tax return due date plus timely filed extension. That is, open the solo 401k plan and also make voluntary after-tax solo 401k contributions for tax year 2025. So these slides break down each self-employed entity type regarding the deadline. So if your self-employed business is taxed as an S corporation or it's an LLC taxed as an S corporation, then let's talk about the voluntary after-tax solo 401k funding deadline. And we talked about this already, but it doesn't hurt to review it again. So for an S corporation, you're going to have until March 15 of 2026 to open that solo 401k plan and make that voluntary after-tax solo 401k contribution for tax year 2025. If you file a business tax return extension for that S corporation, so a Form 1120S, then you're going to have until September 15 of 2026 to open that solo 401k plan and make that voluntary after-tax solo 401k contribution for tax year 2025. Now, for a sole proprietorship, self-employed business, or an LLC tax as a sole proprietorship, you're going to have until April 15 of 2026 to both open that solo 401k plan and make tax year 2025 voluntary after-tax solo 401k contributions. If you filed a personal Form 1040 tax return for that sole proprietorship, then you're going to have until October 15 of 2026 to both open the solo 401k plan and make tax year 2025 voluntary after-tax solo 401k contributions. If your self-employed business is taxed as a partnership or an LLC taxed as a partnership, then the setup deadline is going to be March 15 of 2026. So if you set up that solo 401k plan by March 15 of 2026, you're going to be able to make voluntary after-tax solo 401k contributions by March 15 of 2026. And then you can make, you'll be able to make voluntary after-tax solo 401k contributions for tax year 2025. Yes, you can also make them for tax year 2026 as well. If you file a Form 1065 extension for that partnership, then you're going to have an extra 6 months. So you're going to have until September 15 of tax year 2026 to open that solo 401k plan and make voluntary after-tax solo 401k contributions for tax year 2025. So that's how the deadline works for those various self-employed entity works. So the way the setup works is that here at my solo 401k financial, we'll create the solo 401k plan. That's a custom built plan that allows for the Mega Backdoor Roth strategy, specifically for voluntary after-tax solo 401k contributions as well as conversions. Of course, that solo 401k plan that we provide also allows for solo 401k participant loans, self-direction, comes with a $1,500 auto contribution credit built into it. So once we draft those solo 401k plan documents, then after that, we'll obtain a tax ID number. That's an employer identification number for the solo 401k. The solo 401k requires its own separate employer identification number because it's a retirement trust. We'll obtain that as part of the setup process. Then we'll shepherd you through setting up those brokerage accounts on the institutional side. We can pre-fill the forms out for you, or you can fill them out yourself and submit them to your back channel, or we can pre-fill them out for you and you can submit them to your back channel on the institutional side. Once they're open, then you can make the contributions and process the Mega Backdoor Roth strategy. And then going forward, we'll provide the ongoing compliance support, including performing the Form 1099-R reporting as well as other reporting, which we'll touch on here in a little bit. So step one, for those who are advisors on the institutional side and are looking to open up a solo 401k plan here in 2026 for their clients so that they can process the Mega Backdoor Roth solo 401k strategy in 2026 by making tax year 2025 voluntary after-tax solo 401k contributions, then the first step is to set up the solo 401k plan. And here at my solo 401k financial, we specialize in providing a solo 401k plan that allows for the Mega Backdoor Roth strategy. And then we're going to help you open up the brokerage accounts on the institutional side, whether it's Fidelity, Schwab, Alters, or any other broker dealer that you cleared through. You get to choose your broker dealer. And then you're going to make those contributions by the deadline, including extension. As the advisor, you retain the investment oversight. The assets are held at the institutional platform of your choice. We don't sell investments. We don't offer investment advice. We handle compliance reporting, and we're plan document providers for the plan. So you don't have to worry about my solo 401k financial stepping on your toes. So one of the big differences between my solo 401k financial and other providers is that we don't decide where to hold the funds at. You, as the advisor, in conjunction with your client, decide where to hold the funds for the solo 401k plan at. As I mentioned already, it can be held at Fidelity, Schwab, or Alters on the institutional side, or the broker dealer that you clear through. That's between you and your client regarding where you want to hold the funds at. So the value that my solo 401k financial brings to you as an advisor is that not only do you retain the assets under management, but you get to choose the broker dealer where to hold the solo 401k funds at in conjunction with your client. We also have expanded planning services, meaning that our plan allows you to plan what you want to do within that plan, such as performing the Mega Backdoor Roth, processing participant loans, self-directing the plan into private equity, hedge funds, equities, of course, and other alternative investments. And of course, the Mega Backdoor Roth strategy. So that's why a plan for my solo 401k financial is advisor built. We provide the compliance support and the flexibility of you to choose where to hold the funds at. So when you look to open a solo 401k plan with my solo 401k financial, we make it very easy. We have an online application that we use to collect the necessary information to draft those plan documents. We'll then provide a download link where you can download those documents and the client can sign them. You upload them back through our portal, and then we shepherd you in setting up those brokerage accounts on the institutional side for the solo 401k plan. And then we'll perform calculations for contributions for your clients. And that's all covered in our annual fee. We're going to talk about the auto contribution credit as well. Now, here at my solo 401k financial, we'll perform the ongoing compliance support, such as issuing Form 1099-R, and that Form 1099-R applies if you take a distribution, process a conversion, whether converting voluntary after-tax solo 401k funds or pre-tax solo 401k funds. We'll go ahead and perform that reporting as long as you timely request that service. You can request that service by going to the Forms tab of our website and completing the online conversion or distribution form. That'll prompt us to issue the Form 1099-R. We'll also handle Form 5500 Easy reporting. A Form 5500 Easy is an informational return that has to be filed with the government once the market value of that solo 401k plan is greater than $250,000 as of the end of the plan year. For example, if the market value of the solo 401k plan is greater than $250,000 as of December 31st of 2025, then the Form 5500 Easy is due to the IRS by July 31st of 2027. We have an online Form 5500 Easy request form that you can fill out so that we can add that plan to our queue to prepare that Form 5500 Easy for your client. So let's see here. Looks like we've got a question here. We're also coming towards the end of our webinar today. So again, please subscribe to our YouTube channel. Please also like us across the various social platforms. Also join our community where we have over 32,000 members. You can post forums. If you're an advisor, you can even join and post blog posts and link it back to your company's website so that the 32,000 plus eyeballs in our community can review your services and they may reach out to you for your services. Here's the link to our community. It's www.mysolo401k.net/my community. So here's a question here. In regards to Section 603 of Secure 2.0, for payroll in 2026, we look back to 2025's payroll is over 145,000. The catch-up must be Roth, right? This is going up to 2027 for 2026 payroll. So you're referring to the, let me pull up a page from our website. Looks like you're inquiring about the new rule where for certain entities, if you want to make a catch-up contribution, whether the normal catch-up contribution for those who are age 50 or older, or the super catch-up contribution for those who are ages 60, 61, 62, or 63, those have to be made as Roth solo 401k catch-up contributions and can no longer be made as pre-tax solo 401k catch-up contributions. Let me get to that slide regarding those contribution amounts. So looks like I don't have the limits for 2026 on this slide here, but actually I should have them here. Give me a moment here. Let me pull up that page from our website as well regarding the catch-up Roth, mandatory catch-up Roth contributions. And I'm going to share this page with you as well. Give me a moment here. I also want to get to my slide here, which I thought I already had here on display. So here we go. And here's the link I want to share with you regarding the mandatory Roth catch-up contributions. So number one, it went into effect for plan year starting January 1st of 2026. So tax year 2025 is not impacted, which means that contributions made for tax year 2025, those are not impacted by this new mandatory Roth catch-up contribution regulation. It's only going to be, it only applies for tax year 2026 contributions and going forward. So if you open a solo 401k plan for the first time in 2026 and you want to make tax year 2025 contributions, then one, it's too late if you're self-employed business is taxed as an S corp or as a partnership. But if you're self-employed business is taxed as a sole proprietorship, you still have time to open that solo 401k plan here in 2026 so that you can make employee pre-tax or employee Roth solo 401k contributions for tax year 2025. Now, the new mandatory Roth catch-up contribution does not apply to all entity types. It only applies to S corporation and C corporation self-employed businesses. Therefore, if your self-employed business is a sole proprietorship or a partnership, you still will be able to make the normal catch-up or the super catch-up contribution as a pre-tax solo 401k contribution for tax year 2026. Because again, tax year 2025 is not impacted. So whether you're a sole proprietorship or a partnership, you're not impacted by this new mandatory Roth catch-up contribution. Instead, it only applies to, again, S corporations and C corporations. Let me share my screen here so I can share this page here I'm looking at on our website. Give me a moment here. And we did a webinar on this topic a few weeks ago. So this page here also has that video, the video link to that webinar embedded in that page. Give me a moment here while I get to that. I'm going to share that page here. Surrounding the mandatory Roth catch-up contributions. So here's the webinar that we did on this specific topic. So we'll talk about it here at a high level, but if you want to really hone in on it, view this post here in that webinar that we performed. So again, it only applies if you're self-employed business as an S corporation or a C corporation. It does not apply to partnerships or sole proprietorships. And the way it works is that if your W-2 wages, and actually it's specifically your W-2 wages, let me pull up this section here. It's going to be the, it's box 3 of that W-2. If those wages are 150 or over $150,000, then you cannot make pre-tax employee catch-up contributions. You instead have to make those as Roth solo 401k catch-up contributions. So if the wages are greater than greater than $150,000 in 2025. So if you have a W-2 with 150,000, if you have a W-2 that has greater than 150,000 of W-2 wages, then you would have to make that catch-up contribution for tax year 2026. Again, not 2025, for tax year 2026. And that would have to be treated as a Roth catch-up contribution, not as a pre-tax contribution. And it's specifically, pull up that information, or give me a moment here. It's box 3 of that W-2. Trying to find it exactly here. Give me a moment. Let me get to that box here. So here we go. I'm going to highlight this for you here. There's a good example. So it's going to be your Social Security wages reported in box 3 of the Form W-2. So you need to review that Form W-2 for your S Corp or C Corp for tax year 2025. And if that amount is greater than $150,000, then you're not going to be able to make the catch-up contribution as a pre-tax contribution. You're going to have to make it as a Roth solo 401k contribution. So take a look at this good page here. And that $150,000 is supposed to be indexed for inflation each year. Now, what's interesting here is that if you're opening up let's say you're opening up a self-employed S corporation or C corporation business for the first time, here in 2026, then that mandatory catch-up is not going to apply to you, to your self-employed S Corp or C Corp for tax year 2026. Why? Because if the business wasn't established in 2025 and therefore there's no W-2, then there's no W-2 to look at to determine that $150,000 or more threshold. So if you're opening up a new business for the first time in 2026, then your plan is not going to be subject to that mandatory Roth catch-up contribution. And we actually cover that on this page here. But obviously, if you already have an S corporation, so you had an S corporation in 2025 or in prior years, then it is going to apply. But if you are opening up a self-employed S corp or C corp for the first time here in 2026, and therefore you're opening up a plan for the first time for tax year 2026, then that mandatory catch-up Roth contribution rule is not going to apply to your business for tax year 2026. And it'll apply in 2027, but not 2026. So again, take a look at that page there. It's got some good information, and also look at that webinar. See if we have some more questions here. Here's a question. I would like to make an investment with a partner on a property. Is that possible? If so, can you enter a contract, or does the investment need to be in a formal business such as an LLC? Yes, the self-directed solo 401k offered by my solo 401k financial allows for investing in alternative investments, including real estate, whether physical real estate, such as commercial, residential, or even farmland. And if you want to partner with an investor, then there are many ways to go about that. One, you and your partner, investment partner, I presume we're not talking about your spouse. So your investment partner can form a limited liability company and pool your funds in that same LLC. So your partner may invest personal funds in that LLC. You would invest your solo 401k funds in that LLC. So now the funds are pooled in that LLC. And then you would send funds from the solo 401k directly to that LLC bank account. When you go to make that investment in real estate, it would be made through the LLC that was funded with solo 401k funds and that partner investors' funds. So title to that property would be taken in the name of the LLC. And then all the expenses and rental income would flow through that LLC. The solo 401k is a member. So therefore, the manager of that LLC, which cannot be you, it would need to be that individual or someone else who's not a disqualified party. That manager will ensure that a Form 1065K1 is issued for the solo 401k on an annual basis to report those earnings for that solo 401k ownership portion in that LLC. So you're going to get a K1 each year. Let me see if I can pull up some examples from our website here. Give me a moment here. See if I can find that here. So here's the good link here, and it goes over how to make sure that that Schedule K1 that would be issued to the solo 401k to document that solo 401k's gains in that investment, that is the LLC, how those are reported on that K1. So take a look at this link right here. Now, that's one method of making that solo 401k investment. Another method is it could be done through a tenants in common. That's where the investment partner and your solo 401k are both listed on the recorded deed as tenants in common, listing the percentage of ownership by each party. In this case, the solo 401k and that individual. So title will be taken in the name of the solo 401k plan as well as that individual's investment partner's name. And then all the rental income and expenses would flow through that investment partner's personal bank account and then to your solo 401k. So it's a little cleaner if you pool the funds in that LLC because they all flow through that LLC bank account. That is the investment into the LLC, and then the rental income and the expenses will flow through that LLC's bank account. We have a lot of good information on our website regarding investing in solo 401k and real estate, whether through an LLC or its tenants in common. And you can search this box right here for keywords on there. You can also email us your particular investment situation and we'll take a look at it. Let's see here. We have some more questions here. The property would be fix and flip house. So that's going to add some complexity to the transaction. Typically, a solo 401k plan is not used for flipping real estate. And it's typically not used for flipping real estate because it could trigger unrelated business income tax because it could be deemed a non-passive investment. When you make an investment with a solo 401k plan, such as real estate, you typically want it to be a long-term hold. Long-term meaning that property is owned by that solo 401k plan for a year or longer. So it doesn't trigger unrelated business income tax, which is typically 38%, and it's paid by the solo 401k, and it applies to any income over $1,000. Any gains over $1,000 from that investment. Now, the industry norm is that you typically don't want to flip more than 1 or 2 properties a year in a solo 401k plan or in an LLC that does the flipping. So whether it's directly to the solo 401k or an LLC funded by the solo 401k, because again, it could trigger unrelated business income tax. And so again, the rule of thumb is to typically not perform more than 1 or 2 a year. And that also, you also don't want to make that, you also don't want that to be the sole investment activity within the plan, meaning that you're not just flipping real estate, but you're also investing in other passive investments like equity or long-term real estate holdings where it's a rental property, where rental income is flowing back. You're not just investing in a property that's going to be flipped within a year. Okay, so it looks like we've come to the end of our webinar. We'll be live again here in a few hours. But thanks again for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so that we can keep building this community. Until next time, have a great rest of the day.